You are listening to The Vocal Technologist. Spoken Tech for your ears.
Welcome along. Look, the world of digital assets moves incredibly fast, almost dizzying sometimes, right?
Absolutely. Hard to keep track.
Exactly. So today, we want to cut through some of that noise. We're going to unpack some really significant recent shifts. We're talking new laws, big institutional moves, even how people are thinking about investing in this space.
Yeah, the idea is to connect those dots for you, not just what's happening, but digging into why it matters and, what the bigger picture might look like.
Okay, so let's start with the regulatory side. There's been a huge development there.
Huge is right. The Genius Act. It's actually law now.
Wow. First major U.S. crypto law.
That's it. And it passed with really strong bipartisan support. House 308, 122, Senate 6830. That kind of agreement is rare.
Yeah, tells you something.
It really does. It's a massive validation for the industry. And what it does fundamentally is it forces federal agencies to figure out rules for stablecoins, who can issue them, how they're overseen. It's setting new ground rules.
Right, setting the stage. And speaking of stablecoins, Tether's reaction is interesting. Paulo Arduino, the CEO, he's saying they'll comply as a foreign issuer, which, okay, but they're also developing a separate U.S.-focused institutional stablecoin. That feels like a bit of a turnaround.
It's a very calculated pivot, yeah. They see the writing on the wall with regulation, but instead of just complying, they're finding opportunity within compliance. And, well, with $13 billion in annual profits, they've got the resources to build something specifically for the U.S. institutional market. Quite the move.
Definitely a sign of adaptation. So how does this help stablecoins actually get used, like, day to day?
Well, that's where players like Mastercard come in. They're positioning themselves very strategically as the bridge.
The bridge between crypto and traditional finance.
Exactly. They're using their network, their expertise in compliance, things like their multi-token network or crypto credential. It's all about building trust and making it easy and compliant to use stablecoins for real-world stuff. B2B payments, sending money overseas, paying creators.
Embedding that trust layer.
That's the key. That's what you need for real mainstream adoption.
Okay, let's shift gears a bit. Institutions are clearly getting more involved. What's happening on that front?
We're seeing some big steps. NASDAQ filing to add staking for BlackRock's big Ethereum ETF, ETH.
Right. That's the largest one, isn't it?
Yeah.
Billions in assets. And ETFs had record inflows in July.
They did. $2.27 billion. So adding staking, that allows holders to earn yield on their ETH through the ETF. It makes the product more attractive, more sophisticated.
And the expectation is the SEC will approve this.
Analysts seem to think so, yeah. Probably looking at maybe late 2025. And it's not just BlackRock. Others like 21 Shares, Grayscale, they're doing similar things. It shows where the market's heading. More features, more yield for these institutional products.
And it's not only ETFs. Charles Schwab is making a direct play now, too.
Yeah, that's another big one. Their CEO announced they'll be offering spot Bitcoin and Ether trading directly.
Why now?
Client demand, basically. People are asking for it. And it lets Schwab compete head-on with places like Coinbase. Plus, regulators seem to have eased up a bit on banks post-FTX, making it easier for traditional players to get involved. It brings crypto right into, standard wealth management.
Okay, so regulation is getting clearer. Institutions are jumping in. What does this mean for how you, the listener, should be thinking about crypto investing? There's this interesting idea floating around about rethinking your make-it number.
The dynamic target idea.
Explain that a bit. It's not just picking a dollar amount and selling everything.
Right. The concept is, instead of a fixed exit point, you set a target for your fiat portfolio, say $3 million, just as an example. Once your total portfolio grows beyond that, you only trim the excess crypto to maintain a certain balance, maybe 50-50 crypto and fiat.
So you're taking some profits, but you stay exposed.
Exactly. You keep your core holdings, like Bitcoin and Ethereum, so you don't miss out on potential future upside. It's less about timing an exit and more about managing your overall wealth while staying in the game.
And tied into that, there's this thesis about Bitcoin specifically, a generational shift.
Yeah, the idea is we're seeing a major rotation. Older holders, maybe early adopters who bought much lower, are selling, but they're being replaced by new demand institutions, ETFs that don't have that same history or price anchor.
So fresh money coming in with different expectations.
Precisely. And this new wave of liquidity, according to this thesis, could push Bitcoin significantly higher. Some models are even suggesting, potentially north of $400,000 in this cycle.
Yeah.
It positions holding even one Bitcoin as potentially a life-changing opportunity.
That's a bold call. What of the stablecoin side again? Circle's valuation seems incredibly high based on future growth.
Yeah, Circle's aiming for a $56.8 billion valuation, but that really hinges on some pretty ambitious projections. They need the whole stablecoin market to hit something like $3 trillion by 2030.
Wow.
And they need to keep a big slice of that pie, maybe around 29%, to hit their massive revenue and profit targets. It shows the potential people see in stablecoins, but there are definitely hurdles.
And any immediate risks?
Well, one thing to maybe keep an eye on is investor lockups expiring in December 2025. That could potentially put some selling pressure on related assets, just something to be aware of.
Okay, so wrapping this up, the big takeaway seems pretty clear. Crypto isn't just some niche thing anymore.
Not at all.
It's rapidly becoming a recognized asset class globally. You've got regulation adding clarity, big institutions stepping in seriously, and investment thinking becoming, well, more sophisticated.
It's a convergence, really, all these forces coming together. And it leaves us with a pretty interesting question to ponder, doesn't it?
Go on.
As these digital assets, especially stablecoins, get woven deeper into traditional finance, what kind of fundamental changes could that trigger in our economy's structure? And, maybe more importantly for you listening, how might that redefine what financial freedom and participation even look like down the road?
Spoken Tech, for your ears.